Hey there, everyone. Happy Tuesday, July 7th. Welcome to Chart This with Dave Keller. I'm your host, Dave Keller, coming to you from a gorgeous summer day here in Redmond, Washington. Clouds are a little darker here for the Keller family and other fans of USA soccer after a pretty tough loss last night to Belgium. I will tell you, there's a lot of optimism about the U.S. team going very far. Those of us who are more soccer realists and understand the global soccer environment and just how good a team like Belgium is, I had low expectations we would actually be able to pull off a dramatic victory. However, that was a fun World Cup to watch in terms of the U.S. Getting to where they did. Super proud of the home team, super proud of the crowds in Seattle, in LA, and other places where the U.S. team played, and just enjoying it. So now the pressure's off for the U.S., and we are enjoying watching other teams try to get to the final match. Having said that, we have a lot of great things to share with you today in terms of market activity. Kind of a risk-off day, to be honest with you, in so many ways. The market opened weaker, had a nice rally in the afternoon, but by the end of the day, really teasing the lower end of the range. Defensive sectors doing a lot better today. Energy at the top of the leaderboard as some headlines out of the Middle East look not so great again. We get crude oil prices spiking higher. We get energy stocks spiking higher. Technology at the bottom of the leaderboard as we see further rotation away from the AI trade, AI skepticism alive and well. A lot of charts to review with you, and I would tell you this is one of those pivotal times where really reflecting on the difference between short-term noise and long-term signal, I think, is crucial. You will be tempted, as you may already have been, to overreact to one day's action. Try to fight that natural urge. You will be tempted to make long-term decisions in your portfolio based on short-term data. I always tell my premium members, make short-term decisions with short-term data, make long-term decisions with long-term data. We will do our best here today on the show to connect what we saw in the markets today and how that connects to that larger picture that we are always trying to paint for the overall market environment. We're live streaming on Facebook, LinkedIn, YouTube, and X. Appreciate you guys tuning in live. Those of you who are doing so on any of those platforms, if you're watching live, just ask questions as we go along. We'll try to grab some of those through the course of today's episode. If you're watching the show later on our YouTube channel, welcome. Thanks for checking it out. Please tell a couple thousand of your friends. That would help a great deal. But also use the comment section on our YouTube channel to ask questions. We're planning an all mailbag episode on Friday, and we'd love to address your questions there. All right, let's talk about the major market averages. A lot of red when you're looking at the front page here, except for some more defensive areas of the market like the Dow Utilities Index. But for the S&P 500, ended the day right around 7,500. That's down about 0.5% from yesterday's close. The Nasdaq Composite, even worse, down 1.2%. The Nasdaq 100, the mega cap growth, down the most, down 1.8%. It was down even further earlier in the afternoon as I was reviewing a bunch of charts, but recovered a bit going into the close, but still pretty negative here. Volatility, though, given the fact that stocks are pretty volatile today, and given the fact that a lot of growthy indexes were down, the VIX remained fairly muted. Now, the VIX moved quite a bit today, ranging from around 15.5 up to 16.5, but by the end of the day, right above 16. And that VIX level of 16 essentially means the options market is pricing in about a 1% daily change in the S&P. That's kind of a normal threshold. VIX above 16 obviously means we're expecting larger price swings. That's why we look at a VIX above 20 as a kind of red flag level, because it tells you the options market is pricing in some more significant swings. There's actually an indicator that tracks the VIX of the VIX, kind of like the volatility of the VIX. I think it's $VVIX on the stock charts and maybe some other platforms. It's not something I use very often, but I know it exists, and I'm pretty sure it's got to be pretty high today, given the elevated shifts in the VIX. But overall volatility remaining fairly low. VIX down around 16 tells the options market's pricing in pretty stable environment. Spike in the VIX would be a red flag. We're not seeing that just yet. Looking at rates, we can see the rates generally moved higher today. By the way, I had a really good interview earlier today. Latest episode of the Market Misbehavior podcast coming your way later this week with Jeff Klingelhofer. He's a portfolio manager at Aristotle Pacific Capital. He spent his career in the fixed income space close follower of the Fed. So we talked about the Kevin Warsh era, debriefed on the Jerome Powell era, talked about this new Fed chair, expectations for rates, the long end versus the short end of the curve, thinking of the credit part of your portfolio, thinking about the fixed income exposure and duration and inflation and all sorts of Asians that I was able to ask him about. Such a pleasure to ask someone like that, questions about the Fed and about rates and what it means for our portfolio. So I hope you enjoy that conversation coming very soon. But we reflected on the fact that rates are bouncing a bit higher here to start the week. 10-year yield just about 4.5% now. The long bond yield above 5%, where it's been below that for quite some time. You can see across the curve, we generally drifted higher here. So the yield curve has generally been flattening here. We're getting a bit of a steepening here through the course of this week. As yields are going up, that means bond prices are generally going down. So the TLT down about 1% today. Dollar strength may be one of those themes we really want to stay keyed in on because we're seeing the dollar push above that parity level of 100. This is the UUP, which is a bullish dollar ETF, up about 1/3% today. Looking at the commodity space, energy certainly top of mind with the energy sector doing the best. The headlines out of the Middle East, less awesome, less encouraging than we've seen here in recent weeks. There's been a lot of, I would argue, the market pricing in kind of a Goldilocks situation of everyone getting along, everyone abiding by all the things we're signing. Things are just going to kind of cool off. Global oil supply just kind of restarts with no issues. Days like today, you're seeing that's not necessarily what's happening. To be clear, I've got bets on crude oil and energy stocks going up, just expecting something like this happening. So a bounce like this, I think, makes a ton of sense. I feel like the market is underpricing in the fact that things will not be super smooth and that we'll have some disruption. I feel like that seems straightforward to me, but things that seem straightforward to us, sometimes the market doesn't play out that way, but that's why we make bets and see what happens. So crude oil, both crude oil indexes, these are the futures we're looking at, both up over 5% today. It's obviously a key story in the energy space. Precious metals continuing to struggle. We've covered how the gold chart, I would argue, is still very much in a primary downtrend. We're seeing lower highs. We're seeing lower lows. We're seeing moving averages sloping downwards. I think we've got a pretty clear trend line on the chart of the GLD that is not being broken anytime soon. From my take on the trend. So further weakness in gold, I think, makes sense here. Gold and silver both continuing to follow through on that downtrend. Cryptocurrency is kind of choppy today, but generally slightly lower. We can see Bitcoin currently trading around 63,750. We'll call it. Ethereum prices down as well. Top 10 coins tracked on stock charts, all in the red. Had a really good interview, by the way, on the Market Misbehavior podcast earlier. This was actually last week with Mike Willis, who's the CBO of Cyber Hornet ETFs. If you're thinking about crypto, if you've never thought about crypto but want to understand a little bit more about how a portfolio manager would be thinking about that space and just how the space is evolving, some of the key milestones and how to read those, Mike did a really good job kind of doing a brief history lesson of Bitcoin and other cryptos, where they came from, signs as they progressed, and kind of some expectations going forward. Is a really good, I think, sort of thought and sort of thought experiment on the larger sort of arc of the evolution of Bitcoin and other cryptocurrencies. So you can find that on our YouTube channel. I would encourage you to check that one out with Mike Willis of Cyber Hornet ETFs. All right, continuing on our look at the 11 S&P sectors. Energy back at the top of the leaderboard. Of course, when crude oil prices are spiking, you'd expect energy to pop higher. 2.8% for the XLE, and that's the top performer. Healthcare and real estate both up over 1% today, rounding out the top three. Some other defensive sectors up there as well. Consumer staples certainly up there. That offense to defense ratio, I haven't showed that chart in a little while. And the short answer why not is because it's just been kind of choppy, sloppy sideways for some time. There's no real clear message, I would argue, in the relationship between offense and defense. It's more muddied right now. And even on a day like today, you're seeing kind of a mixed bag of things up and down. Today was a little more better for defense than offense, to be sure, when you look at the sectors that were up and that were down. But if you look over like the last couple months, it's sort of flipped back and forth, where defensive sectors are working quite well, and then they're not doing as well on a relative basis. and the ratio of consumer discretionary to consumer staples sort of demonstrates that balance between those two. Technology, of course, continuing to give back some of those hard-fought gains from Q2. Some of the leading semiconductor names like Micron, like SanDisk, which we shared on the show yesterday, and we'll update that chart today, all sort of in various stages of rotation downwards, testing key support, in some cases breaking key support. And I think that's important to recognize. Of course, how much do these stocks retrace? I mean, of course, it depends on who you ask. People that have just been so against the AI trade and have sensed obvious euphoria are feeling very vindicated. I've also read and spoken to people who are long-term AI and technology bulls who see this as the most obvious buying opportunity in the history of the technology sector. The answer may be somewhere in the middle, but I think my approach to that sort of thing is to focus on the charts, right? To key in on those key levels, those key guideposts, those signals, lines in the sand to sort of anchor your process to. And we'll do our best to identify some of those on charts like SanDisk here in today's show and in shows to come. Industrials and materials, the last two at the bottom of the leaderboard today. Breadth actually was not great, or it was pretty good, depending on which area of the market you're looking at. On the New York Composite Index, the NYSE, which is my favorite measure of breadth, just because it's a pretty diverse group of stocks. You've got pretty big names down to pretty small names and a bunch of things in the middle. Does it include all the growthy Nasdaq names? Of course, it does not. But is it a good sort of general barometer of participation in the equity space? I would argue it's the best that we have available. So that's the one that I generally want to use. On the NYSE today, 41% of those names were up, 57% down. That's not great. And the Nasdaq Composite, much worse, actually, arguably some bearish numbers, almost a 2-to-1 ratio, decliners over advancers. But then you look at the S&P 500, 57% of the S&P were actually up today. So the S&P very much the outlier. It tells you there's some large cap names doing better than average. And we're seeing that reflected in the Morningstar style boxes as well, which is what we're showing here. Here are the 9 Morningstar style boxes: large cap, mid cap, small cap, value, core, and growth. Great sort of simple visualization to think about what happened today or on a different time period if you're able to do that. So, themes today, certainly value over growth, because you can see that the value column generally outperformed the growth column on all of the different cap tiers. The other thing I would say is generally large cap better than small cap. We can see large cap value, the best performer, basically flat for the day, small cap value down about 0.75%. The worst area of the market today, mid cap growth down 1.8%. Looking at the Dave's Dirty Dozen, these leading growth names and related ETFs that I think are important to keep a close eye on at all times, given their size and impact on our equity benchmarks. Meta by far differentiating itself, up 2.6% today. Chart of Meta gapped higher last week, sort of chopping around, but this week sort of resuming that uptrend. 580s, that short-term tactical low. That's the upper end of that price gap that we observed last week. For now, that level's holding pretty good, up another 2.6% today. Amazon and NVIDIA also up as well. On the downside, this is where the pain is. SpaceX, actively testing that 150 level. That was the opening trade after the IPO last month. Down 7% today, basically retesting that opening trade. Micron and Tesla both down over 4% today. Micron, SanDisk in particular, testing key support. Now, the rest of this group of stocks were not down too much, but those are some of the biggest gainers and then biggest losers within that pivotal group of mega cap growth stocks. All right, we're going to continue on here looking at the heat map. I see some really thoughtful questions, and I'm going to grab a couple right now before I forget to do so, because a lot of times at the end of the episode, I go, yeah, there was a question about half an hour ago, and I'll try to grab some right about now. There we go. 3 that I wanted to get to. All right. By the way, keep the questions coming. Any of the questions we don't get to today on the episode, we will put them in the mailbag. We're planning an all mailbag episode on Friday of this week. Those mailbag episodes are a lot of fun good opportunity to dig into some of the questions you guys are asking and really think about, how we can make better decisions, how we can improve our approach and our decision making. All right, looking at the heat map, you will note the upper left corner is where there is a serious concentration of the color red. That's the technology sector, and it is in a number of different groups, but especially in the semiconductor names, right? Micron, AMD, Intel, Applied Materials, LRCX, KLAC. These were all down anywhere from 5 to 10%, we'll say, depending on the individual name. So that's obviously one key theme. Nvidia and Microsoft, two of the biggest names in the XLK, and I know Microsoft's not a semiconductor name, but it is one of the largest names in tech. Those were two technology stocks at the top of the market cap list that were actually up slightly today. So I think that's worth noting. I mean, neither of those are particularly great charts at the moment, but worth noting. The software space actually did quite well today, right? So we're seeing this differentiation between semis versus software, and this is rotating away from semiconductors and back into software. So you've got names like ServiceNow popping higher. I mean, is ServiceNow a great chart? Like, I don't think you could ever describe that as a great chart from a technical perspective, at least not in the way that I think about charts. Do we think about that as a stock that is coming off of a major level of support? Absolutely. Can we recognize the fact that this stock sort of bottomed out around 85 to 90, 4 or 5 different times in the last 3 months? I think we could say that. Have we seen enough signs of accumulation through today's close that give you a high confidence that this is just the beginning of further upside? And this is where I would argue you probably cannot. If you look at the structure of a chart like ServiceNow, this is where the technical configuration can be quite helpful. What's happened right now is we've now tested support. So I think thinking of like 90 as an important level of support, validated level of support, I think that's a very good way to think about it. What would we need to see? What would I need to see to say this is now a really good chart we want to pay attention to? Is two things, right? Getting above the 200-day moving average means we're clearing these previous swing highs. This is where previous rallies have stalled out. So let's see that something's different. Getting back above the 200-day is something we haven't been able to observe over for the last 12 months. So I think that would be pretty meaningful. RSI getting above 60, that would be one of the ways to validate that the momentum is strong enough to potentially see a sustained move. Now, back here at the end of May, we did see a nice breakout. We did see a test of the 200-day moving average, and we did see the RSI go above 60, but we stalled out at the 200-day. So we have to have all of those ingredients, I would argue, before this goes from a neutral chart to a pretty bullish chart. And you also see that on the weekly chart. And this is where I think weekly charts can be really helpful, because then you can see 2026 is basically this big, choppy, sideways kind of price action. Almost looks like an inverted head and shoulders, although it's not a great example of one, but it does kind of give that vibe and certainly shows this higher low around 90. Seems pretty meaningful. But for me, that's still a market in consolidation. A market in accumulation means we break above those swing highs and break above the 200-day moving average. Here we're looking at the 40-week moving average as a good sort of proxy for that on the weekly chart. All right, so that's what happened in technology. What happened elsewhere? Kind of a mixed bag day, but not a great day for the financial sector. I would say the same thing for consumer discretionary. Sort of a lot of mixed results. I would say, other sectors that stand out, the industrial sector, certainly the red that we're seeing in a number of the largest names here. Some of these are just off of fresh new all-time highs like GE, GEV, Caterpillar, right? Back below $1,000 a share. That breakdown sort of started last week and it kind of came down. John Deere was sort of threatening previous all-time highs from February, kind of coming off. Eaton Corp, which actually made a new all-time high last month, now swinging lower. So a number of industrial stocks, which actually had looked pretty encouraging, many of them kind of rotating lower, which makes a chart like Waste Management, ticker WM, look pretty good, and that it's not going down on days like today. Days like today are really helpful to pay attention to the heat map and see which stocks actually reversed the market trend, right? Which stocks are actually up in an impressive way at a time when the benchmarks were flat to down. WM is one of those. Now, this is what we talked about on previous charts. A breakout, right? Breakout above resistance, breakout to a new swing high, RSI pushing above 60 is pretty encouraging. So I think that's a good example of maybe a constructive breakout. So limited great charts within the industrial sector. The material sector also, especially mining names, getting dinged as gold and other metals are going lower. To finish off, which areas of the market look pretty strong on the heat map? Besides the software areas of tech, I would say in the healthcare sector, this is where certainly there's a lot of really impressive charts. Gilead is a great example of why a simple trend line can be really valuable. All we do is we kind of look at them, and I'm going to just do this for speed, but kind of get the idea, right? You draw a trend line in some different sort of way, but however you draw this trend line to match like the major highs, we've broken it. And so I think this something has changed now on the chart of Gilead in the biotech group from a clear downtrend of lower highs and lower lows to all of a sudden a nice rotation higher, breaking above trend line resistance. We're now testing that swing high, so let's make sure we get higher. But the RSI pushing above 60, so indicating a bit of a shift in momentum. Gilead's a pretty interesting chart, actually. I would like to say. So other healthcare stocks, I actually grabbed a couple of them. I didn't grab Gilead, but I grabbed a couple others, so I won't talk anymore about that. The energy sector, of course, a lot of these stocks have been coming down as oil prices have been dropping, but nice counter trend rally today. That's it for the heat map. We're going to continue on here in a moment. Before we do so, I do want to give a shout out to one of our partners, Seeking Alpha. As a reminder, they're actually just finishing up their summer sale. I think you've got maybe 1 or 2 more days before they're going to wrap this for the season. So check it out today if you're interested. Marketmisbehavior.com/seeking alpha. They're offering 25% off to my viewers checking out a new account. If you sign up today, you'll get access to their top stocks for the second half of 2026 webcast that's coming up next week. Steve Kress, who runs their quant team, he's actually going to be coming on the Market Misbehavior podcast later this month, is going to host that event. They will be talking about applying their quantitative model, lessons learned in the first half, and outlooks for the second half. Should be a really good opportunity to learn about how successful investors have used quantitative practices, and Seeking Alpha has got a pretty good setup for that. Again, marketmisbehavior.com/seeking alpha for more info, and encourage you to check it out. And thanks so much to my friends at Seeking Alpha supporting Market Misbehavior. All right, let's continue on looking at some charts that I have hand selected to review with all of you. So yesterday on the show, we talked about the S&P 500 breaking out of this symmetrical triangle or coil pattern. A coil pattern is a consolidation formed of lower highs and lower lows. And if you watch yesterday's episode, we said, hey, this break above the upper boundary is pretty impressive. Now we need a follow-through day. And we actually had some comments in the chat about what a follow-through day represents. For me, and for a lot of investors, it means different things. And 3 of my kind of mentors, some that I worked with very closely, some whose work I just followed very closely, John Murphy, who I wish I would have worked directly with way more often than I actually did, but certainly it was the first book I ever read on technical analysis was John's seminal work on the topic. And then I did have an opportunity to work with Tom DeMark for a number of years at Bloomberg, and then Larry Williams. I overlapped a lot during my stock charts years, and all 3 of those, if there's one consistent part of their process, they all talked about some idea of a follow-through day. Whether it was, trading 1 or 2 ticks in that new direction, which is what Tom DeMark actually would look for. John Murphy was a little looser, talking about like a day that continued in that direction. That's kind of usually where I end up more on the subjective side of things. But recognizing that an initial break, we should be a little bit skeptical until we get that follow through, right? That next day, that next bar sort of shows you that it wasn't just a 1 bar fluke kind of thing. It was the beginning of something more significant. And that's what we did not get from the S&P today. Now, the S&P chart did not get back into this coil pattern, but it failed to follow through from yesterday's close. So I think for now, still not quite a valid breakout on the chart of the S&P. The momentum stalled out, did not get above 60. So at this point, it's still neutral momentum. With that lack of follow through, I'm skeptical that this breakout is a good one just yet. What's also really interesting, and I have to thank one of my Market Misbehavior Premium members, and a quick plug for that, marketmisbehavior.com/premium. Check it out. We have a premium membership, which includes virtual courses. It includes member-only reports, like my weekly flight plan, which goes out every weekend, and a member community. And in our community overnight, one of my premium members posted a similar chart of the Nasdaq 100 index and said, how does this coil pattern relate to the S&P's coil pattern? It's awesome to have that community where we can ask questions and I can share some insights. We can all learn together as we navigate these markets. So again, marketmisbehavior.com/premium. Check it out if you're interested. Completely different, right? Similar structure, similar triangle, similar coil pattern of lower highs and higher lows. But while the S&P is breaking and sort of testing its coil pattern resistance level, it's kind of a potential breakout this week. The QQQ same day is actually breaking down below its lower boundary. So the Nasdaq 100 potentially resolving this coil pattern to the downside. I mean, what better illustration of this leadership rotation away from mega cap tech and growth into other areas of the market, right? These coil patterns having completely different resolutions, at least this week, certainly pretty meaningful. Now, same rules apply, right? On the S&P, we broke out and it was, all right, do we get follow through tomorrow? So I think the same thing applies here. We had a breakdown today. Do we follow through tomorrow? Do we get further weakness? QQQ below its 50-day moving average for the first time since the beginning of April, coming off that March low. So the Nasdaq 100, I would say, very much testing key support here, showing an initial breakdown sign. We'll look to see if we get follow through tomorrow. But while the Nasdaq 100 is breaking down, how is the S&P looking so much stronger? Excuse me. I would say this example, this chart is one reason why, right? One good illustration of why the breadth conditions speak to the underlying strength outside of mega cap growth. And when you look outside the Mag 7 and look outside of tech, there's plenty of charts that are looking pretty good here. This is the bullish percent index on the S&P 500, which has been actually trending higher over the last 6 weeks, while the S&P itself is sideways. So we have the benchmark sideways. We have the breadth improving, which tells you that there are plenty of stocks doing just fine, even though the benchmarks are stalled out. I'll tell you what's not doing just fine is the chart of gold. We will review this chart regularly and just keep updating it. Yesterday on the show, we talked about this move up toward the 21-day EMA. Today, we opened and traded right up almost to the penny to the 21-day exponential moving average before rotating lower. What is this two-candle pattern? I know it's a bar chart, but if you know these patterns well enough, the candle patterns actually pop up on the bar chart, and it's almost like you're looking at a candle chart. That's what sort of happened to me. I've looked at so many bar charts, it just kind of pops up. And I would tell you the opposite pattern is what we see right here. Here we have a big down day and then a big up day, wider range on day two. Here we have the opposite, big up day, then a big down day. Day two engulfs the range of day one. Correct answer, a number of you. Thanks for weighing in. The bearish engulfing pattern, 100% right. So bearish engulfing pattern is a two-bar pattern. We have an up day and then a down day. Day two's open to close range engulfs day one. So you think about a big up day, a higher open, a weaker close, kind of a classic short-term reversal. So gold having a nice counter trend rally, but when you see a counter trend rally and then you start to see a bearish engulfing pattern, that makes me think, ooh, that's not a great, the chances of us just continuing higher probably low before some sort of at least a tactical pullback. So not getting good trend or momentum vibes from the chart of gold just yet. Now, crude oil had a pretty good bounce today, went from around $68 a barrel at the end of last week up to over $72 a barrel. The 200-day moving average is up here around 74. I think the $80 level is where I'd start to get pretty excited about it. Now, I put on some sort of bullish oil bets here in the last couple of weeks, playing on this downward trend to, basically thinking that the market is pricing in way too perfect of a situation in the Middle East. And I was pretty sure there was going to be some re-escalation. Maybe what we heard today is the beginning of that. Maybe it's just a one-day thing. I'm not sure. But I'm not surprised that we're getting a day like today. It's always felt like we're one bad headline away from these downtrends reversing. Now, what would make a meaningful change on this chart? Well, it's been oversold, right? It's been going down a ton, and it's in a pretty strong downtrend. We're now pushing higher. Getting above the 200-day would be good. Getting above $80 a barrel, I think, is an important threshold. Below $80 a barrel, it's easy to think of crude oil as just not a big idea, not a big deal. Getting back above $80 a barrel, that becomes a very real issue that I think a lot of investors will have to start to price in terms of their expectations. Talk about a choppy, sloppy, sideways chart. This is the relative strength of offense versus defense. One of the ways we like to think about that ratio is by looking at the consumer sectors. consumer discretionary, things you want, versus consumer staples, things you need. The idea is that consumer discretionary is a little more tied to consumer sentiment, right? When we feel pretty confident, when we've got plenty of money to spend, and we're happy borrowing money, we buy expensive things like travel and tourism and hotels and luxury goods and new clothes and new watches and all that kind of stuff. But when things are bad, we don't buy those things, but we still buy toilet paper and alcohol and tobacco and beverages and cleaning products, kind of like those basic things you need to, simple things to keep your life going. So this is a great way of looking at that relative performance of things you want versus things you need, offense versus defense. And if you look, this ratio on the cap weighted version, which is the top panel, I mean, almost dead sideways. We're pretty much just chopping around over the last couple months. The equal weighted version has been more volatile for sure. But if you look at where this ratio is right now, it's about where it was in February. So last 5 months, we've basically gone nowhere on this ratio directionally. So offense and defense pretty mixed right about now. It tells me to be watching this for some sort of meaningful breakdown, but we haven't really seen that yet. But we also haven't seen a lot of optimism. And I think that's one thing that's missing from the bull case right about now. All right. Speaking of AI trade, NVIDIA and Broadcom, obviously two names which are in the semiconductor group, but are starting to really struggle. And other names like Micron and SanDisk have obviously remained quite strong. But we're seeing a pretty significant downtrend. I just want to highlight NVIDIA testing a confluence of support right now. We've got the 190, 192 level, comprises the 200-day moving average, comprises a 61.8% retracement. And look at how the chart of NVIDIA is testing that. By the way, if you want a good example of how to use Fibonacci retracements, I think the chart of NVIDIA over the last 6 months is about as good as you're going to find. If you take the March low and go to the May high, look at that first pullback to the 38.2% level. We bounce, we go to the next drop, and that finds support at the 50% level. We go up, and now we're testing the 61.8% level. I mean, if all charts looked like this, I think everyone would be a fan of Fibonacci retracements. They're not all like this, but this is a pretty classic example of where Fibonacci retracements can help you identify some key levels of support. And as a swing trader, that's where you can start to identify where might we see some buyers come in and bet on some short-term swings. Not a change in trend, but just a shift in momentum that allows us to benefit on the short-term bounce. So for now, NVIDIA sort of bouncing off of those levels, kind of a bullish outside day today with a lower open and a higher close, testing that support at the 200-day moving average. Maybe that holds. I think NVIDIA below 190 is a really dangerous development and could be an issue. And the problem is you've got some of these kind of AI-related names, right? And certain part of this AI sort of supply chain starting to struggle. We saw the Mag 7 names come down. We're seeing NVIDIA and Broadcom coming down. Is this the beginning? And then it's, upstream in the AI sort of life cycle where you see further and further breakdowns. Is that how this bubble eventually bursts? Perhaps. Let's keep a watchful eye on key levels of support. Speaking of names elsewhere in the AI sort of infrastructure play, we've got SanDisk and Micron both featuring some weakening momentum readings, both sort of actively testing their 50-day moving average, kind of a bullish, call this a hammer candle. You might call this a dragonfly doji, I might call this one, where the open and close are almost identical. They're near the upper end of the range, long lower shadow, not much of an upward shadow. So testing the 50-day moving average, but a nice short-term bounce indication maybe on the candle pattern. But testing the 50-day, the SMH also testing its 50-day, also with a bit of a hammer candle there as well. Similar. A lot of these charts look the same, where you see higher highs in June on weaker momentum. And so I think that's certainly something to watch. SpaceX, as I mentioned, testing that opening level, right? The IPO price was down here at 135. Trading opened at 150. That was, second week in June. From there, spiked very high. And then a couple days later, we're right back around tripping to the opening trade. Literally, as of today's close, anyone that bought SpaceX after the IPO is now at best flat and at worst big time underwater. And this is the danger with IPO charts like this. I've just seen it happen too much for me to really get excited about following an IPO. But let's watch that 150 level. The opening trade can often be an anchor price that a lot of people are going to be keying in on. There's going to be a lot of desire to hold that level of support, which keeps everyone at least in the wishful thinking camp that SpaceX recovers from there. But let's keep an eye. Another bearish outside day, by the way, for Berkshire Hathaway. I think we featured this on the show yesterday, but I can't remember. Just wanted to note we're actively testing key resistance. We've got a short-term reversal candle, suggests maybe that resistance holds for the next couple days as well. Now, with all these charts that are kind of in downtrends or breaking down or testing support, are there charts out there that look good? I finish every episode with, it's always a good time to own good charts. Here are 3 that I found today. Pretty good charts, all in the healthcare sector, because that was one of the sectors that did quite well today, besides energy, which obviously was at the top of the leaderboard. Healthcare was in the top 3 as well. Here's Eli Lilly, one of the largest names in the healthcare sector, just over $1 trillion market cap, making a new all-time high today. Here's Johnny John, also one of the biggest names in the pharmaceutical space, making a new all-time high today, up 3%. United Health Group, not quite making a new all-time high, but continuing to trend above, upward trending moving averages. On charts like this that are going higher, I think the general approach I use is innocent until proven guilty. I think that these charts are great charts until I see something that shifts. And I would say with United Health Group, something to observe here is the weaker momentum, right? This is something we picked up on with charts like Micron and SanDisk, great uptrends, but stalled out momentum. And we're starting to see a bit of that as the momentum is weaker and weaker on these new highs. As long as that 21-day EMA is holding, though, I think that's still a pretty good chart. All right, let's finish off with a question or two, and we'll see what happens. I did see some questions here. Let me go. Oh, boy, more of a big picture question. If anyone wanted to pursue a career in finance, what's the right way? What we do in studies and how we learn trading? That is a wide open question, my friend, and I appreciate you watching, and I appreciate you asking the question. Here's my and I get a lot of people reaching out over the years and just asking for career advice of some sort. Here's what I always tell people that are super early on. Your goal, particularly if you are not in the financial industry and you want to get in, or if you're just in the financial industry and want to progress, I would say number one, especially earlier in your career, you want to be a sponge, right? And the ways you can be a sponge, meaning you just absorb as much information as possible. And then I think as your career progresses, you start to use all of that accumulated knowledge to start to make a name for yourself and start to progress in whatever industry or career or firm you're in. And then you get to your later stages of your career where hopefully you're starting to give back and mentor others. And it's not just a direct path. There's a lot of overlap in those phases, but early on, you want to be a sponge. And the way you're a sponge is by reading a bunch of books. The good thing about the financial industry, about technical analysis, about investing, psychology, there's just so much written on that. If you're looking for things to read, if you're not sure where to start, go to my website and click on the reading list at the top. I would read all these books. Start with these 3. How to Make Money in Stocks. We'll talk to you all about fundamental versus technical analysis, how to think about equity and stock picking from a balanced perspective of the companies and then the stocks. Reminiscences of a Stock Operator, fantastic book, still one of the best about trader psychology, about supply and demand, about fear and greed, and just how the basic tape reading skills that Jesse Livermore is talked about doing still very relevant in 2026. And then Manias, Panics, and Crashes by Kindleberger will teach you all about the boom bust cycle, which has repeated itself so many times, and it will repeat itself again in the future. Those are the 3 I would start with, and I've got a bunch of other books below there. So number 1, read a ton. Number 2, start to connect with others in the industry. I've been involved with the CMT Association for decades, and I would encourage you to find your local CMT chapter, meet other people that are doing the things and have the jobs and positions that you'd like to have, and introduce yourself. Most of the people I've hired, anytime I've been able to do so, have come from, knowing them through my own network. So build your network. And then the third thing is start a blog, start a YouTube channel. Even if you don't ever share the link with another human being, have your ideas in some sort of date and time stamped format. So when you do go to apply for that awesome job that you're ready to have, you can show them, here's what I've been thinking for the last 6 months. Here's how I've navigated these markets. Here's when I was wrong and what I did about it. Those are the 3 things I suggest to people. I hope that helps. And I wish you much success if that question was for you personally. Let's see. Shoot, I just hit the wrong button, and I had a great question, and then I just deleted it. So give me like 12 seconds to find this one again because it was really good. It was something about, let's say I sold too early, then I want to get back in. Here we go. At J Ross. Found it. Let's say you made an emotional long-term decision based on short-term data. Hey, admitting you have a problem, that's the first step in any 12-step program. So good for you. Good on you for boldly admitting to that. How would you get back in? Although you didn't say it was you, but I get it. How would you get back in today? Would you scale all in or wait? So listen, here that's always a tough question, right? And what do you do after something bad happens and after you make some bonehead mistake? For me, my argument would be don't overthink it. Go back to the basics, right? We often think, all right, well, I missed it. Now what do I do? Start over, right? And if you're more of a top-down investor, all right, evaluate the condition. Is this the time when I should be putting money at risk or taking money off the table, right? Raising cash or raising risk. And think about which of those your answer is. And depending on that answer, start thinking about how you want to be allocated and think about which positions make sense to you right now. What are the good charts, right? And again, that could be charts that have been going up for a while. That doesn't mean you missed it, right? Things that go up a ton first, and then they keep going up. That's something you learned from the William O'Neill book that you see on your screen. So I would say go back to just sort of the basic fundamentals of chart analysis. Think about the checklist that you might want to use and just evaluate what are the best charts right now. And let me start putting some initial positions into those and start to scale back in. Going 100% all in may feel very difficult, so put half at work, right? So take smaller positions, but put something on there so that you can start to gather some data on what your performance is and where you go from there. Awesome questions. Those were pretty good ones, and I appreciate it so much. We are done for the day, though. Thank you so much, those of you tuning in live on Facebook, LinkedIn, YouTube, and X. Appreciate you guys asking some thoughtful questions. We didn't get to all of them, but I'm going to review this list and get some of those into our mailbag. Hopefully, we can answer some of them on Friday's episode. In the meantime, have a wonderful evening, and remember, it's always a good time to own good charts. Take good care, folks.